Right, a very good morning to everyone who is joining us today. My name is Alex Kanye. I'm a partner at Cliff Decker Hoffmeyer in the Kenya office. Today, we have an interesting discussion around the Finance Bill 2025. And basically, the Finance Bill 2025 is what sets out key changes to our tax laws. And the proposed changes will have a huge impact on how we do business here in Kenya, hence the reason why we're having this conversation. It's good to note that the bill is still in a draft stages, or rather, it's just a bill and open for discussion before it's then debated in Parliament and passed on to become a law. But even as we discuss that, it would be good to welcome anyone who's not joined any of our um, webinars before. We've had quite a couple of webinars, and this on finance bill also happens to be very important. For those who are new to the firm, Cliff Decker Hoffmeyer is a business law firm in Kenya and South Africa, and also getting to Namibia. That's where we have our physical offices, but we have a capacity to actually help our clients across Africa on a number of areas and sectors. And basically, we're able to take care of any part of the business, be it when the business is just starting to its growth phase, or in the unlikely event that also we need to support it when things are a little bit difficult. In the Kenya office, we have various specialties across M&A, real estate, banking and finance, um, intellectual property, environmental law, dispute resolution, just to mention but a few. So for today's discussion, we'll structure it in this way. We'll have some just highlights around what is happening in the country in terms of the economic outlook, which I'll discuss in the next few minutes. Then my colleague Dennis will speak to us around the tax changes that could affect some of the sectors, just key sectors that we have highlighted. And then finally, we'll ask ourselves, so what next and what role can you play? So first, let me introduce Dennis. Dennis is an associate at the firm, and supporting the tax team. If he may want to say something more about himself when he comes on, so we'll wait to hear that. And welcome, Dennis. So straight to the presentation in terms of Kenya's economic outlook. As at 30th of April this year, when we look at just the tax revenue projections for Kenya, we were at about 2.1 trillion Kenya shillings in terms of our collection. When you compare that against last year, 30th of April 2024, we were about 1.9 trillion, which kind of reflects some form of growth in terms of our revenue collection year on year of about 6.1%. But even when speaking about revenue collection, you have to think about the target for this year, which ends in June 2024, vis-a-vis the target that, if you were to kind of apportion the target as at end of 30th of April 2025. And what we're able to see is that there's still some shortfall, because we were at 96.5% in terms of revenue collection vis-a-vis targets as at 30th of April 2025. Of course, this points to some form of deficit against budget, even though there's year-on-year growth. And we'll wait to see how the year ends in June to see whether the Revenue Authority will be able to collect whatever is required in terms of our revenue targets. Well, looking to 2025, 2026, the year that starts from 1st of July 2025 and ends on the 30th of June 2026, what we're able to see is that government intends to collect revenue of about 3.36 trillion. And this 3.36 trillion is tax plus any other revenue that the government would get, including from appropriations in aid. Yeah, so that's what we're looking at vis-a-vis a budget or proposed expenditure of about 4.24 trillion for the year 2025-2026. So as you can see already, these budgeted deficit, if I may call it, of about almost a trillion, if you call it, yeah. And of course, that for us as tax expert, what that means is that we expect then the Revenue Authority to continue being aggressive to ensure that they kind of collect whatever is required from their end, so that then the government has doesn't have to borrow much to finance the budget for 2025, 2026. In terms of growth in the budget, last 2024, 2025, the projected expenditure or budget was 4.1 trillion. So you can see some little increase there in terms of how much we expect to spend in 2025, 2026. So just in terms of an overview, that's how we are looking at this finance bill in that context of the government wants to actually collect revenue to finance its budget. Well, when you look at our GDP, it grew at 4.7% in 2024, as you can see in the graph below. 2020 was, of course, the hardest hit because of the COVID period, where we saw a 0.3% drop. 2021, we bounced back with 7.6% growth. 2022, 4.8%, and 2023, 5.7%. 2024, 4.7%. So in terms of 2025, what do we see in terms of projected growth of our GDP, and which is a measure of how our economy is performing? The World Bank puts it at 4.6%. Our national treasury is, of course, very ambitious, and they're putting it at about 5% in terms of growth. So just to give you context, if you're operating or doing business in Kenya in terms of just how the economy is performing. Of course, they normally argue that these rates compared to developed economies, of course, our rates here in developing economies would be higher than those developed economies. But again, you have to also take this in comparison with other East African countries that perhaps Kenya is also competing against in terms of trying to attract resources. So with that general introduction, I want to welcome Dennis, who will then take us through key highlights in terms of sector by sector, where we see the government trying to propose changes through the finance bill, and then I'll pick it up later. Welcome, Dennis.
Thank you, Alex, and hi, everyone. So I'll be taking you through the key highlights per sector. We focused on the main sectors in the economy, and I'll also take you through some of the key highlights for employees, as well as some of the tax administration changes that we are looking at. So to begin with, we'll start with the financial and investment sector, where we are seeing the government is trying to attract more investment into the Nairobi International Financial Center. So this center was first introduced in July 2022, where the government was trying to attract investment and position Kenya as a financial hub. But since its launch, we've only seen 3 companies register in the center. And this is because it doesn't offer a lot of incentives other than the preferential tax rate, which is offered to such companies. So with this finance bill, the government is looking at increasing more investment into that. And the first one is for startups. They will have a preferential corporate tax rate, which is graduated over a period of 7 years, with the first 3 years the CIT rate being 15%, and then for the next 4 years being 20%. So another proposed change is that for companies that are certified under the NFC, they'll receive a preferential rate of 15% over 10 years, and then another 20% for 10 years. So after the 20-year period, then they will revert to the normal CIT rate, which is currently at 30%. And for you to benefit from this preferential tax rate, then there are three conditions. One is that you must have a large investment into the country, and the investment threshold is set as at 3 billion shillings, which is quite significant. But looking at the kind of companies the government is trying to attract, then this is a good threshold. And then for holdco and holdco companies, there's a local shareholding. There's a local requirement where you must have 70% local employees who are in the top management. And for regional headquarters, which are set up, then 60% of the local employees must be senior management. So another one is dividends will be exempt if the company that is in the NFC invests at least 250 million back into the country. So when it distributes its dividends to the shareholders, they should be able to demonstrate that they're investing back 250 million into the country, and then such dividends to their shareholders will be exempt. Another key one for the financial sector is withholding on qualifying dividends and interest will be a final tax. So qualifying dividends and interest, this relates to dividends distributed by resident companies other than SACCOs. And then for interest, this is interest from approved financial institutions like banks and certain corporate bonds. So currently, the withholding tax rate for qualifying dividends is 5%, and for qualifying interest, it's at 15%. So what this means is that once the withholding tax has been withheld from source, then you will not be required as a taxpayer to remit any more taxes on the same. So that's a welcome move, and this has been anticipated for quite some time. The next one is the real estate and housing sector. So this one has been hit in a negative way. We've seen the removal of the tax incentives. So the first incentive that is being scrapped off is the preferential CIT rate of 15% that is normally granted to developers of 100 plus residential units annually. So this will mean is that for such developers, then the CIT rate going forward, should this proposal go through, that they'll be paying CIT at 30% like normal companies, which will basically increase the costs for such residential units, and this will have an impact on the taxpayers as the final consumers. Again, VAT exemptions on goods which have been imported or being manufactured locally, which are meant to for the construction of affordable housing is being scrapped off, and we're not too sure why the government is scrapping off these VAT exemptions, because part of its Big Four agenda is to enhance the affordable housing agenda. So with the removal of this VAT exemption, it basically means that the final consumer will bear the cost, which will be significant, because now we are looking at 16% on such goods. Another interesting one is the interest deduction. So as a taxpayer individual, where you take a loan from a bank to construct a home, you will get a deduction of up to 360,000 on such loan. So basically, it means that this amount will be deducted from your taxable income before pay can be deducted on it, which this is a welcome move for the taxpayers, and this is meant to incentivize people to go more into home ownership. So the next sector that I'll be looking at is the manufacturing sector, and here we are looking at one of the incentive being scrapped off and the other one being introduced. And the first one is the investment allowance. So previously we had the government incentivizing people to build up factories or manufacturing sites outside Nairobi and Mombasa in an effort to decongest the big cities. And how they did this was introduced 100% investment allowance on any costs that were incurred building such manufacturing sites outside Nairobi. And there were three conditions. One is that you must have invested more than 250 million, sorry, outside the two counties. And also one of them also could be SEZ. So they were trying to attract investment in SEZ that are outside the two counties. And so if you invested in such SEZs, for example, those in Naivasha, in Thika, then you'd get 100% investment allowance on the costs. But now I think the government is looking to remove this incentive, probably because the uptake has been low. But we are making a proposal that they should reconsider this proposed amendment. Another one is in the steel sector. So this is an interesting one, which people have various views about it. But for the final consumer, this will mean that the cost of importing steel, which has been quite high since the COVID era, will reduce because the export and investment promotion levy is being reduced from 17.5% to 10%. So that's a welcome move in that regard. In the automotive sector, this is another sector that has been hit negatively, and this is because the government is looking to remove actually most of the incentives that had been granted to such taxpayers and such companies. The first one being the preferential tax rate of 15% will be scrapped off, meaning local vehicle manufacturers will now be paying CIT at the rate of 30%. For VAT, any inputs, any material that is manufactured locally or is imported for the manufacture of passenger vehicles or locally manufactured vehicles, then will be standard rated. So this is moving from zero rated to standard rated, and the import of this is that the cost of building such vehicles will be higher. So it looks like the government is trying to kill this industry in some way, but and there are proposals right now by the body for the government to reconsider this move. Another one is the VAT for electric bicycles and electric buses manufacturers is moving from zero rated to exempt. So while the tax effect will be almost similar, this normally has an implication because if you are exempted, it means that any costs that you incurred in the manufacture of your products, you cannot claim them. And this is input VAT. So basically what this will mean is that whereas the final consumers are not being charged VAT on the product, it will mean more costs for the developer because they cannot claim the costs that they incurred, and then this will also translate into the final product. So we'll see an increase in such goods. In the digital economy, we are seeing a few changes, some which are good, some are meant to bring clarity in the industry. So CEPT, which is a new tax that was introduced last year in December, we've seen the government now trying to widen the scope so that it now includes services that are offered in the internet, and electronic networks, so that it's not limited to digital marketplace. And another one is the removal of the threshold. So the digital economy department in KRA has been having challenges with trying to enforce the issue of CEPT because some non-resident taxpayers were saying that they've not met the threshold and for paying CEPT because they were saying the income that they're getting from Kenyans in terms of digital services is less than the 5 million. And for some of these taxpayers, they are very large companies, but in terms of income they are generating from Kenya does not amount to the 5 million. So what KRA has sought to do is now remove the threshold so that any income that they're getting from Kenyan residents is also taxable in terms of CEPT. For DAT, we've seen a reduction from the 3% to 1.5%. So this digital asset tax, this is a welcome move, and this was introduced sometime in 2023 by the Finance Act 23, and it had experienced challenges for quite some time, I think until last year in October or November, when we finally saw the iTax being modified to allow taxpayers to pay this tax. And despite the challenges that were there, we didn't, the KRA did not see it materialize. So as a form of incentivizing non-residents to pay the digital asset tax, they are looking at reducing the same to 1.5%, because currently it's DAT applies on the value of the asset that you're transferring, and in most cases, or depending with the economic outlook, then you might be selling an asset at a lower price than you got it for. So this means more costs for such taxpayers, and we've seen a scenario where non-residents in the crypto market were looking to leave the country because of such change, this DAT and the previous DST. So what KRA has done to incentivize them to remain in the country and continue trading is reduce the DAT which is payable on such assets. Another introduction is excise on digital services. So previously, excise on digital services only applied to non-residents, but now the government has sought to increase this so that to also include the non-residents also offering digital services to Kenya. Okay, so I'll move on to the next slide if there are no questions. Alex, okay.
Yeah, I'm thinking this is a good place for anyone with questions just on those two slides that we have covered in terms of the sectors that are being affected. I'd encourage the questions to come now, and then we proceed to the next sectors that are likely to be affected. So, we are able to also pick the trends that are happening here in terms of government trying to reduce its tax expenditure, and by that I mean cut off a number of tax incentives that it has traditionally provided to some sectors. Of course, the reasoning might not be very clear, and even the timing, because there are some investments that have been made, hoping that the government will continue to provide some of these incentives. But happy to hear your questions. Okay, feel free to also type the questions on the chat, just in case you have a question. If I think I'll just give maybe like 30 seconds. If there are no questions, then we move on to the next couple of slides highlighting the other sectors that are probably being affected by these changes. Okay, there's a question from Elizabeth and from Ian. Let me see if I can be able to see those questions properly. Great. So Elizabeth asks, will the VAT on electric bicycles be passed on to consumers? Yes. Well, what happens if your products are zero rated? What would happen is that whatever cost you incur in terms of you being charged VAT to be able to manufacture the input VAT, if your product will be zero rated when you're selling it, what would happen is that you'll be able to claim that input VAT as a refund from the government in terms of a VAT refund. But the move from zero rated to exempt, it basically means that the manufacturers, the guys dealing in electric bikes and electric buses, will no longer be able to claim refunds from the government for that input VAT that they incur for production or in the business of these electric bicycles and buses. So what is likely to happen is, if that input cannot be refunded by the government, of course they'll find a way to pass it on to the consumers. So there's a likelihood that there will be an increase in the price for electric bicycles and electric buses if this proposed change in finance bill was to pass. Dennis, maybe you have a comment on the excise duty on digital services. So the question is the excise on digital services an additional tax?
It's not an additional tax per se. What the government has done is just increase the scope to also include non-residents, so that because currently it only applies to resident taxpayers, but now they want to also introduce it to non-resident companies that are offering digital services that are being consumed by Kenyan residents. So I think that answers it.
Okay, thank you, Dennis, for that. Maybe we can then move on to the next sectors that are likely to be affected by this finance bill. Thank you.
Okay. So the next one is in terms of tax administration, which the government has been very vocal about it. So in terms of tax administration, they are looking at closing some loopholes that have been utilized by taxpayers to minimize their tax, and also try and minimize tax that they are paying out in terms of refunds, which again, I think based on the analysis they did, they realized that they are paying out so much money in terms of tax refunds, and some of these refunds are not genuine. So I look at the first one being where the obligation to carry forward tax losses has been limited to 5 years. So previously, this had been increased to perpetuity. So you are allowed as a company to carry forward your tax losses forever until you're able to be in a taxable position. But the government has realized that some companies are constantly in a perpetual tax loss position, which they are now looking to limit this to 5 years, so that after the 5-year period, any tax loss that has not been utilized, then it sort of expires. And if you have any tax losses that you not utilize after the 5 years, then those are forgone and you now start paying taxes. So this is a big hit on some companies, and there's a proposal. We are making a proposal to submission to the parliament that they should reconsider this proposed amendment. The next one is on the commissioner, where the bill is now seeking to require the commissioner to explain where they make amended assessments. So previously, where KRA did an additional assessment on your self-assessment return, then they were required to give reasons, but this did not apply where they decided to amend your return. So if this happened currently, KRA will just amend your return and just tell you you paid CIT of this amount X, but this should have been the amount paid, and not give you any particular reason. But now they're supposed to give you reasons like, for example, we've reviewed your financials, or we've gotten this information, and based on this information, then the CIT that should have been payable is this amount. So that's a welcome move for taxpayers, because now this gives you enough grounds even when objecting to such assessments. Another one is extension of enforcement mechanisms. So we've seen a few taxes being introduced that cover non-residents, such as the minimum top-up tax, the digital asset tax, the significant economic presence tax. And the challenge that KRA has been having is that after notifying a non-resident company that they should be paying this tax, the question that these non-residents are always asking themselves is, if I don't pay this tax, what will happen? So since the enforcement mechanisms for KRA have always been limited to the territory of Kenya, this bill is seeking to expand the scope and this power, so that any non-resident, wherever you are, KRA can enforce you to pay tax in Kenya using the same enforcement mechanisms we have in Kenya, for example, attaching property, issuing agency notices so that if, for example, a bank holds certain amounts of money for you, then they are required to pay that amount on tax that is payable. So this probably is seen as a way of increasing the taxes that they are collecting, because there's been a lot of profit shifting around this area by non-residents. Another one which is detrimental is the issuance of agency notices, where one has been appealed. So KRA had tried this some time back, and there are even court cases in relation to this. So when KRA makes an assessment and, for example, you object, you don't win at the TAT, if should you want to appeal to the High Court, the next thing that KRA used to do is issue an agency notice to your bank telling them that this amount is due by this taxpayer. Please make payment to this account. But this issuance of agency notices is normally limited where a taxpayer decides to appeal the case, because a taxpayer might have a genuine case and then they win this at the High Court, and there would be a challenge trying to claim this money that has already been submitted to KRA after you've won your appeal at the subsequent courts, because like we know, KRA is normally very reluctant in making refunds, and internally they have a policy where there's only a certain amount that they can pay out to taxpayers in a year, and the maximum limit per taxpayer I think is set at 3 million. So if you paid out any amount above the threshold of 3 million, then it would be a challenge for you recovering such tax subsequently. Another one which is very controversial right now is that there's a prohibition in the law from sharing any trade secrets or any personal data. And we had seen the KRA try to introduce this proposal in the Finance Bill 2024, which was withdrawn, and they're now looking to reintroduce it in this finance bill. So we expect a lot of feedback from taxpayers in this, because this will, without a proper governance structure, then this could be misused by KRA. And yeah. Another one is in terms of timelines. So we've seen the KRA try and increase the timelines for a number of things in the TPA. So the first one is for refunds. KRA is now seeking to extend the period when they process a refund application from 90 to 120 days. So previously, if you made an application for a refund and this was not the commissioner did not get back to you within a 90 days period, then it was deemed that your refund is legitimate and you are entitled to that amount. But we've seen KRA as recent as on Monday trying to say that they've realized that they are fictitious traders who are using the loopholes in the refund process to claim illegitimate refunds. And on Monday, they also, I think, let go of 74% of their department that deals with refund. So this will be a major hit to taxpayers, because having to wait for 120 days and then now with the constrained department, this will mean that you have to wait for longer to get refunds that are normally genuine. Another one is audit refunds. So when you make a refund application, the normal process is normally for KRA to audit whether the refund is legitimate. And this normally happens over a period of 120 days. But now KRA is looking to increase this to 180 days. So if you look at those two timelines, this could mean that you have to wait almost for close to 1 year before you get any feedback from KRA, because they could take the maximum 120 days to get back to you to tell you that now we are considering an audit, and then another 180 days to audit, which could also increase. So this will mean for taxpayers, especially ones that only deal with zero-rated goods, and they're claiming input VAT on such goods, then you have to wait for longer for you to get these genuine refunds. Another one is the extension timeline for processing of income tax exemption. So this one has been a challenge for KRA because currently they are required to process such applications within 60 days. But in real life, we've seen this even take close to 3 or 4 years before KRA gets back to you. And what normally happens is that they normally justify this by saying they're trying to audit your activities to see whether they are genuine, whether you qualify for the income tax exemption. And we have had so many NGOs, for example, that they are their income tax exemption certificates expired in 2020, 2021, and they're still waiting until now to get a renewal of their certificate. Now, the main question that normally has KRA deals with is what happens between the period when they made the application and when they make their decision. For example, for a company that applied for renewal in 2021 and is still waiting until now to get the same. Remember, these income tax exemptions are normally valid for 5 years, but now KRA is taking 4 years to try and audit your activities. So does it mean that for such companies also get to enjoy the tax exemptions during this period when KRA is auditing? So while the bill is trying to increase this period, I think something that we are looking for is should the KRA not make a decision within 90 days, then it's clear that you get to enjoy the same similar tax exemption that you enjoyed for the previous period, unless something has changed. So that's something that will be proposed in the bill. So that has to limit this. Another one is the timelines for application of VAT refunds. So currently, you are allowed to make refunds for VAT within a period of 2 years, meaning any input, for example, any input tax that you paid in in May 2023, you can make a refund of such input VAT now. But now KRA is looking to reduce this timeline from 24 months to 12 months, which now will mean for taxpayers, they have to maintain a proper record of the refunds that they're claiming, and probably have a proper way of making this refund, so that because as we are seeing, KRA is trying to increase the timeline that they process such applications. So if they increase their time to process the applications and also reduce your time as a taxpayer when you can make such refunds, then it means that as a taxpayer, you always have to be on your toes and in terms of tracking the refunds that are due to you and when they are made. Another one is in terms of objections. So last year, through the Tax Laws Amendment Act, the government had removed the issue of including public holidays and weekends when calculating timelines for making objections or making appeals in terms of tax. But now I think they are looking to reintroduce this, which is a draft move, considering that this amendment was introduced in December last year, and now we are in May, and they're looking to reverse the amendment. So there are proposals by taxpayers to reconsider this proposed amendment so that it can revert to what was brought about by the tax laws amendment, so that taxpayers are able to have more time. For example, if you look at the month of April, when we had 3 or 4 holidays, then it meant for a taxpayer who was making any appeal or objection during that period, their timelines for working was reduced significantly. And that's why the proposal is for the government to reconsider this proposed amendment. Another key one, which comes as a relief to taxpayers, is that if you are withholding agent and you fail to remit withholding tax for a taxpayer, then you will not be penalized for the same, as long as the taxpayer who you are supposed to withhold from has paid 100% on the principal tax. So an example is if I'm a lawyer and you're supposed to withhold 5% on my consultancy fees. If you did not withhold the 5% and subsequently I pay my 30% on that consultancy income, then you will not be penalized for that, as long as that you're able to justify that I paid my portion of the income. So I'm happy to take questions, especially in this section.
All right. You'll notice we've changed the mode of our presentation, so I don't just take all the questions at the end. We don't want you to zone off. And of course, the things we're discussing are quite weighty. So happy to take on questions just for this particular slide before we go to the next one. But basically here, Dennis, like you say, the issue of tax losses being, the current law is you can actually carry them forward for an unlimited period. The plan to limit this to 5 years, of course, will affect a lot of clients, especially if you've enjoyed certain investment allowances, and that is the reason why perhaps the business is in tax losses, and then after 5 years, that is, cut back, and yet when you're investing, perhaps you are being drawn by the fact that you can actually carry forward your tax losses for the longest until you're able to break even and start making profit, then that's something that would be an issue for investors. And the other one that will definitely be of concern is the fact that the Revenue Authority can now issue agency notices immediately after a decision has been made at the Tax Appeals Tribunal against the taxpayer. Issuing agency notices basically means a notice is sent maybe to your bank or to your business partners, telling them that if they have any funds that they hold on behalf of the taxpayer, those funds should immediately be wired to KRA, even as you move to the High Court to appeal against the decisions of the Tax Appeals Tribunal. So that's again a major change, which we hope will be lobbying against come the time for providing comments. So I've been speaking so that if we see if we have any questions. We don't have here, so maybe Dennis, you move on to the next.
Okay. So the next one will be looking at the proposed amendments affecting MNEs or deals. And for deals, we are looking at stamp duty exemption, which has been introduced so that any transfer of property by a company to its shareholders will now be exempt if these two conditions are met. One, the property is transferred to the shareholders in proportion to their shareholding, and two, the shares where the property involves shares, then these shares should be in a subsidiary of the company that is undertaking the transfer. So currently, as it is, the stamp duty exemptions that apply have a threshold of 90%. So if you're conducting any internal restructuring, then you'll get the stamp duty exemption if it involves a transfer of shares of up to 90% if you're the shareholder who owns the 90%. But now you're able to get the exemption if property is transferred to you in proportion to what you own in the company. Where it relates to shares, then this allows for spin-offs. So this basically means if company A owns company B being the subsidiary of company A, if company A decides to transfer or distribute its shares to its shareholders who are the shareholders of company A in company B, then they get the exemption, because basically this will not be a transfer of shares but rather a distribution. So that's a welcome move, and we're looking forward to implementing the same. Another one is on CGT exemption on SEZs. So this is now looking to limit these CGT exemptions, because currently any transfer of property within an SEZ by any entity, regardless of whether they are in an SEZ, is exempt. But the bill is looking to limit this so that any transfer of property within an SEZ is only limited where it involves a licensed SEZ. So basically, this CGT exemption is only applicable to SEZ companies which are transferring property within an SEZ. And there's a proposal to for the parliament to have another look at this, because this is the second tax incentive applicable to SEZ that is being removed, with the first one being the one for where you've invested in an SEZ, you get 100% investment allowance. Now, with the removal of the CGT as well, this will impact investment in this industry, which the government has been trying to attract investment in, and this might also have an impact in investors who made investment in SEZs with this in mind, because now this affects their exit strategy. Because the point of exit is when now you find like most investors try to recoup their profits. So if you try to introduce tax at 15% at that point, then that will reduce their how much they can be able to recoup, therefore reducing the investment. Another key one is now in terms of transfer pricing and M&Es, with the first one being the introduction of advanced pricing agreements, which basically are agreements between a taxpayer who has activities with its related party with the revenue authority. So basically, what the APA does is that you agree with the revenue authority, which in this case will be KRA, that this is our price that we are transacting with our related party. Confirm it at arm's length. If KRA confirms, then that is fine, and the bill proposes to have this apply over a period of 5 years. In other jurisdictions, we have seen this APAs also apply retrospectively. So currently in Kenya, this only does not apply retrospectively, but there's a proposal for this to also apply. But this is a welcome move, because now it reduces the pressure or that comes with facing a TP audit, because you're not sure what KRA will say about your arm's length principle. Because most times you'll find that even looking at the cases that we've seen, you have an arm's length, a TP policy that governs the arm's length principle with their related party, but KRA comes and says that the method that was used to determine the arm's length price is not correct, and this is a method we are using, and this is how much you'd pay. So this will limit such, and it will try and create certainty in that regard. Another one is in the minimum top-up tax. So this is a tax that was recently introduced in December by the Tax Laws Amendment Act, and it normally applies to resident and non-resident persons who are part of an M&E, that is a multinational enterprise that has a revenue of more than 750 million euros. So this is the same threshold that is used for the country by country requirements. And what this proposed amendment is doing is try to bring clarity in terms of when this tax is due, because this had been was not present in the current act, so that now minimum top-up tax will be payable the same time when corporate income tax is payable, which is basically on the 4th month after the year end of a company. So that's just to bring clarity in that regard. So I'll look to move into the next slide before taking any further questions. And the next one is for employees. So the first highlight our proposed amendment for this for employees is that government is looking to increase the limit for tax-free per diem from 2,000 per day to 10,000, which is a welcome move, because the 2,000 was a very low threshold considering inflation and the increase in costs of travel and accommodation. So this is a welcome move. Another one is the introduction of a mandatory obligation by all employees to apply all reliefs, deductions, and exemptions that are applicable to an employee before computing pay. And we did computation to try and look at, for example, for an employee who is paid 100,000, what this would mean should this proposal pass. And looking at our computation is that while this looks like from the government side, the proposal looks like a good deal, this affects the employees in terms of your take home will reduce. So for an employee who earns 100,000, currently they would be taking home around 71,000. 71,600 shillings. But after the proposal passes, then they will be taking home 69,900. So this is a difference of 1,600 in the negative. So you are looking to take home less than you were previously. And this is because, for example, for the personal relief, this will be applied on your gross pay as opposed to the tax that you should pay, that is pay. And that's a simulation of such. So yeah, happy to take any questions. Okay. If none, at this point, I will have Alex take back.
Well, thanks, Dennis. I think employees, that's something to watch out for. There's difference of interpretation. There are people who are saying the move by the government is just to ensure that employers then comply with the requirement to deduct what is required to be deducted before paying the employee. But at the same time, when you look at it technically from a tax point, then we see a problem or a gap in terms of the explanation that the government is providing vis-a-vis what we see as the net take home, and basically meaning that it is a further rate to your payslip. So if we move on in terms of the next steps, we're looking at public participation, and a notice has been sent out already, calling for all of us, including those of us who are here, to send our written memorandum to Parliament through those given emails. And then once we provide those written memorandum, of course, we'll go to the next steps. The most important bit here is to just note the deadline is on the 27th of May 2025 at 5 p.m. So let's just take note of that. If we move on to then the next steps in terms of what we see with this particular finance bill, is that fine? We'll get to present our written memorandum. And even as we present that written memorandum, what we expect is there'll also be physical hearings organized by the Departmental Committee on Finance and National Planning, a committee of Parliament, so that there'll be physical hearings continuing even as the deadline for making return submissions is there. Basically, they'll try to save on time. What we've done before is that we've worked with clients who then tell us there are certain changes that are being proposed which we are not comfortable with, and those clients would ask us to present them before the National Assembly Committee to basically present their grievances around certain proposed changes. And of course, if there are changes that favor you and you want them to also remain within the bill, we also encourage people to just voice them out to say, we've seen this particular proposed change in the bill and we are happy with it. I think that kind of feedback is feedback that the National Assembly Committee also wants to hear from this public participation stage. So once the public participation season is over by the 27th of May, what we expect is that Departmental Committee of the National Assembly to then prepare a report. Basically, they'll go clause by clause and comment by comment provided by the public to say, yes, we have considered this particular comment or suggestion, and our view as the departmental committee is either we agree or we disagree, or perhaps it should be considered or a study should be done, depending on what comments have been provided. Then that report is what is then presented to the committee of the whole house, basically the whole of members of parliament. So they get to discuss the report from the departmental committee and either agree with some of the changes that have been suggested by the committee or disagree. And in some limited circumstances, we've even seen some members of parliament introduce new things that were not in the bill at this particular stage before they then go on for voting, and then they again vote to adopt the changes as they will be, and we then get to see what will be some form of the act that we expect from this particular process. Remember, the bill only becomes law once the bill has been passed and assented to by the president. That's when it becomes finance act and effective as law. So because some of these changes are expected to take effect on the 1st of July 2025, we expect the president to also give his assent around the same time, because there are just about 2 other provisions that take effect from the 1st of January 2026. So in terms of timing for assent, of course, that is just 1st of July or 30th of June, thereabouts, so that this particular act comes into force. So this is what happened with Finance Bill 2024, if you could remember. However, even after this, of course, there was some push and then kind of some withdrawal of the bill in some sorts to make sure that the provisions of Finance Bill 2024 did not take effect. Of course, largely driven by the Gen Z protests that we saw within the country. We expect this particular bill not to have so much debate compared to last year's bill. Perhaps it will be more quieter this time, considering that even the changes that are being made, save for a few, I think most of them look favorable to the taxpayers. So that's what we see in terms of the next steps. Great. So we look like we are about to end ahead of time. We were anticipating that this would end at around 1:30. No, sorry, 12:30 or in the next 30 minutes. But we want to open this session for questions, and we'll provide answers, myself and Dennis. So feel free to perhaps, I don't know whether it's possible to unmute your mic, and if it's not possible, then just type your comment in the comment section or the chat section, and then we'll be able to respond to your question. Thank you. Okay, and even as you ask the questions, there is a survey that we're carrying out, just looking at this particular webinar and how we could do better next time. So please go to your chat box. You'll find the link there that has been sent by our colleague Sain. Interact with that survey and provide us with your feedback. Okay, there is a question here. What's the rationale behind deleting some definition of terms such as tribunals and compensating tax? Dennis, you want to have a go at that?
Part of the rationale, for example, for deleting the word tribunal is just to align it with what has already been provided in another act, for example, the Tax Procedures Act. For the compensating tax, I think there's an argument that this is looking, for example, to remove it from the ambit where it's what's it called? It's considered for as a deduction, meaning that compensating tax will now be an allowable deduction because now it's not expressly excluded. Expressly included as a non-allowable. So by the exclusion, there's argument that this is being allowed as a deduction. So I think that's the rationale that's behind some of that deletion. Yeah.
All right. Thanks, Dennis. Indeed, it's just a cleanup and also looking at that compensating tax from a deduction perspective. Any other questions? All right, so there's a question there to say, other than pension from Elizabeth, and thanks for the question, other than pension, personal relief, insurance relief, mortgage interest, which other reliefs and deductions are eligible for employees? Just trying to understand whether the proposed amendment on employee deductions may be beneficial to some employees. Anything that comes to mind, Dennis?
I'm thinking of deductions around loans, for example, mortgage loans. These are deductions that are normally deducted, other than now the pensions and the reliefs. Yeah.
Okay. Okay, in fact, that reminds me of a very major change for pensions, especially if you want to withdraw early from your pension scheme. It will be very painful if this particular law is allowed to pass as it is, because there are instances where early withdrawal, because maybe of sickness or termination, you could get an amount tax free when you're withdrawing early, but the bill as it is seems to suggest that those reliefs or the monies that you could access tax free when you withdraw from your pension early will then be those provisions will be withdrawn, therefore will suffer full tax. And so I guess for those of us who are looking to exit from pension schemes, it's something to go home with. Then the other question I see is from Jonathan, who asked, the bill proposes having KRA collect what's due to them as one appeals to the High Court, though it doesn't give a timeline on how refunds would be done if one succeeds on appeal. What would a plausible timeline look like? I think, in my view, this one, I think we want to fight it from the onset. In fact, we don't want to look at a timeline for refunds, because even if the law provides, and as it is currently providing for refunds, we know that is quite a painful and long process. So I think the better way would be to say that the appeal should continue to its natural course. It is a taxpayer's right to actually appeal without having to be asked to pay because a decision has been made against them at the tax appeals tribunal. Once they put in a notice of appeal and proceed to appeal to the High Court, then the Revenue Authority should not be allowed to collect until that case is determined fully. Okay, Dennis, there's a question here on how do the employees implement the tax relief on interest arising from a loan used to construct their residential house? And I think this is quite one of the major one of the changes that I actually like, that you can actually get a relief from what you'd pay as your tax if then you have borrowed money from a SACCO or a financial institution, and you're using that money to build your residential home. So what happens is that then if you are supposed to pay as part of your PAYE, or at the end of the year, say you're supposed to pay 10, then you have to take advantage of the interest relief. But Dennis, maybe you have a couple of points to add there.
Yeah, so one of them is just letting your employer know that you've taken a loan, and they should utilize the deduction, for example, on a monthly basis. If that's not possible, then when you're filing your annual returns in June, then that's when filing the returns, you declare the amount of interest that was paid on such loans.
Yeah, I think I like the proactive approach where you inform your employee in advance, so that then they reduce the amount they pay as you want to the government with that particular relief. Otherwise, if you do it towards the end of the year, your employer has already remitted your pay as you want, and now you'll be fine. You'll be taking advantage of the relief, but you end up in a refund position. And if you end up in a refund position, the likelihood of you getting the refund is minimal. Okay, not unless you are not employed, you're into business and you're accounting for your taxes in the installment tax mechanism, where you then perhaps in the fourth installment, you look at how much you're supposed to pay vis-a-vis the relief you're supposed to enjoy, and then you take your tax minus the relief and then just pay the balance. So if you're employed, the best route is to engage your employer in advance. All right. So, Dennis, question for you here. Is there an alternative to deleting the provision that prevents KRA from getting to know trade secrets that would still allow the taxman to meet the objectives it sought to achieve when it intends to delete the said provision? Is there an alternative? When I look at section 59A, I believe, of the Tax Procedures Act of 59, in the traditional sense, KRA still had, leeway to ask for information for purposes of carrying out an audit. But of course, there's been growing concern that some of this information could be trade sensitive. So do you see a leeway when you think about it?
At the top of my mind, I don't see why KRA would need any trade secrets or personal data for purposes of collecting tax, because most of the information that they would rely on is, for example, financial statements, which are public documents, information like payroll data, which is not, you wouldn't call it personal data in some sense, because having to share your trade secrets, for example, things like who owns a certain license for IP rights or such things, or copyright, I don't think that information would be relevant to KRA. And should it be relevant, then there are already mechanisms under the Data Protection Act for how they can acquire such information, rather than removing the limitation. So I think that would be my answer for that.
Okay, thanks, Dennis, for that. I think Pamela Mnyoki has a similar question. I believe you've answered it. Any other questions before we wrap this up? I think I'll give a minute. Okay, we don't have any further questions. So I'd like to thank you for attending this particular webinar. I'm sure the slides or perhaps a recording of this will be shared, where you'll get to follow through whatever perhaps you may have missed, or perhaps you may want a colleague of yours at the workplace to be able to listen in and get some insights from this particular webinar. So that will be done. So looking forward to seeing you in the next webinar, so that we're able to engage. If you're not on our list or mailing list for tax alerts as well, just chat your email within our chat box, or send your email within our chat box, and we'll be able to organize so that you're added to our mailing list for tax. We're also doing podcasts, and we just released one on the opportunities for special economic zones. So that is also available. You can get it from our website, and it's quite insightful in terms of how special economic zones are structured and how you can benefit from that. So without further ado, thank you and see you next time. Bye.
Thank you and bye.